The first week of 2026 just revealed something critical about market psychology that most traders completely missed. While everyone focused on the failed Santa Claus rally and mixed index performance, the real story was hiding in the breakdown of correlations that have defined markets for 3 years. This breakdown signals we've entered a new regime, one where traditional diversification fails and only disciplined systems survive. Here's what actually happened beneath the surface noise. The SPX dropped nearly 1% during what should have been a seasonally strong period. The Dow gained while the Nasdaq declined. Small caps surged over 1% in a single day, then gave it all back. But the most telling signal came from an impossible combination. Gold rallied above $4,400 while the dollar strengthened and bonds sold off simultaneously. This is not normal market behavior. When safe havens move in opposite directions, when precious metals rally alongside a strengthening currency, when defensive assets fail to provide defense, the system is telling you that the old playbook no longer works. The market is repricing everything based on regime uncertainty, not just policy uncertainty. The human layer driving this chaos is pure psychological fragmentation. After 3 years of double-digit gains, investors entered 2026 carrying the weight of stretched valuations and concentrated AI risk. When early January gains evaporated by midday, the message became clear. Participants lacked conviction to chase momentum at current prices without fresh catalysts. The Venezuela intervention added another variable to an already complex decision matrix. Geopolitical shocks typically trigger flight to quality, yet we saw the opposite. Defense stocks rallied while traditional hedges failed. This tells us that inflation fear now dominates recession fear in the collective psyche. Investors are pricing a world where central bank credibility is questioned and fiscal dominance concerns override cyclical growth fears. Look deeper at sector rotation and you'll see the real anxiety. Micron hit all-time highs while Microsoft fell 2%. Semiconductors rallied on AI infrastructure demand while the Magnificent Seven declined 1% overall. The market is differentiating between companies with proven AI monetization and those still living on narrative alone. This is not broad risk appetite. It's tactical opportunism in a market where conviction has been replaced by conditionality. The system layer confirms what disciplined observers already suspected. Bond markets transmitted the clearest signal when 30-year yields hit their highest levels since September. The curve is repricing for a higher-for-longer rate environment. With only 50-50 odds of a March Fed cut, the system no longer believes in the dovish pivot. This repricing cascades through equities via the discount rate mechanism, compressing valuations for long-duration growth assets. Crypto remained range-bound near 88,000 Bitcoin, with the Fear and Greed Index stuck at 34. This isn't strength, it's paralysis. The absence of panic combined with the absence of euphoria creates a base-building environment where patient capital finds opportunity while momentum chasers get frustrated. The Stoic approach to this environment requires 3 principles. First, recognize that extended bull markets don't end with clarity. They end with confusion. The divergence between indices and breakdown of traditional correlations signals a system in transition. This is not the time for conviction trades based on momentum or narrative. Second, understand that geopolitical volatility is now a permanent input variable, not a temporary disturbance. A market that rallies on tariff delays and military strikes has priced instability it doesn't possess. Portfolios constructed for low volatility will underperform in this regime. Third, adapt position sizing for a world where diversification breaks down. When bonds and equities decline together, when gold rallies with the dollar, when correlations invert, traditional portfolio construction fails. The disciplined response is increasing cash allocation, shortening duration, and focusing on asymmetric opportunities where downside is defined and upside is uncapped. The December jobs report will serve as this week's critical inflection point. A strong print forces further bond repricing and compresses equity multiples. A weak print revives recession fears but confirms labor market deterioration. The Stoic exploiter doesn't position for one outcome. He structures exposure to benefit from volatility in either direction. The first week of 2026 didn't provide answers, it provided questions. The market that answers those questions will look different from the market that asked them. In a system transitioning from momentum to mean reversion, survival becomes the prerequisite for opportunity. If you value systematic thinking over emotional noise, subscribe for frameworks that exploit human predictability rather than follow the crowd. Download the complete Stoic exploiter methodology in the description. because understanding market psychology gives you the edge when correlations break and conventional wisdom fails.